so we'll just talk about real estate.
Yeah. Well, mostly it's just stuff that I know and read, and conversations that I have with people, and I'm mindful of we got 5 minutes to talk about what we're going to talk about, then 3 9-ish minute periods to talk about what we're going to talk about, and then the 5 minutes to talk about what we just talked about.
That's right, exactly.
So I won't get too deep into it in the first segment.
Yeah, and actually this week, a little bit more time actually. And they're running the commercials. One thing that's been pretty good is they've been taking your commercials and throwing them on all kinds of different places.
Oh my goodness! I'm gonna have to check with Bianca and Nam about about how we're doing on that in that regard, because that's
definitely.
Because we are getting some. It's not the Gil Gross response.
Yeah.
But,
because Keith wants to sit down with us, take us to breakfast or take us to lunch. Oh, by the way, do you ever go into San Francisco for dinner?
Yeah, I just went last night.
Really? Okay.
Just to meet someone though. Ooh.
You ever been to Brazen Head?
Bucks. No, I've not been to Brazen Head.
Okay, so it's kind of a little bit of a funky place, but not too bad. You can't make reservations. You just show up, and they won't seat you until your entire party is there. You can. So it's really nice Lombard and all that. Really good food. And nice steaks. They have really good steaks.
I do like steaks. With a brazen head.
The brazen head.
Nice, thank you. That's awesome.
Alrighty.
All right. So I'll get into in the beginning. I'm going to talk about how I like it when it's just you and I. That we can really dive deep into topics that are near and dear to our heart, and that we're going to really talk about where we think the real estate market is heading, and really dive into mortgage investing and get into specifics about our fund, mortgage investing in general, and our fund in specific. So we'll probably dance around that for a while, and in the first 5, and then in the next one we'll go in to I don't know. We'll just kind of take it to see how it meanders and wanders, and then maybe we'll talk about the types of loans we do initially in the first segment, and then been having some conversations with people about the fund lately, so they're asking good questions.
Yes.
Let's
talk about the risks.
Yeah. Talking about people were asking about foreclosures and credit scores. What kind of credit scores do you require? And what happens when interest rates goes up? How's that going to impact you?
All of the questions.
Yeah. Anything that you can think about, questions that you want to throw out. So let's see. So because I've had a great conversation. I was grilled by this woman who's an attorney, real estate investor and attorney, and she was asking about our underwriting procedures.
Was that the Mike Zaidman?
Yeah. Oh, right. Of course. Yeah, I knew you knew that.
But that's good. You say, listen, I just got grilled by a real estate attorney before she invested in the fund, and actually she's going to. But these are the kind of questions she asked. Yeah. Okay. We can take up 40 minutes of that.
Yep. I'll talk about the market in general in the first 5.
Ready?
I am present.
Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hoff of Pacific Private Money, one of California's fastest growing mortgage investment firms, which, by the way, you are still growing.
And fastly.
Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 gifts we're giving away. This time we're actually still giving away the tanning certificates. And those are not sponsored by the radio station, but by Tan Bella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. You got to check out their anti-aging booth. I got to check that out myself.
Laser the wrinkles away.
That's it. Exactly. Very good. Okay, and today's theme is celebrities before they made it big. Now, Mark, it's just you and me today. What are we going to talk about?
Just you and me. You know, Edward, I love it when every couple of months, it's just you and I, and no co-hosts, no guests, and I really love these shows because it's an opportunity for, you and I to really drill down deep in real estate and mortgage investing. I get a chance to really kind of talk in detail about what we're doing at Pacific Private Money in terms of the loans that we're making, privately funded loans, and also get to talk about mortgage investing, and specifically my favorite type of mortgage investing, which is investing in a mortgage pool fund, which I think for most investors today is probably the smarter direction to go because of the competition for quality loans in the private or hard money sector. And we'll get into a little bit of detail today in that show. We've got a relatively short first 5-minute segment here, so we'll talk a little bit about questions that I'm constantly getting these days is, what's happening in the real estate market? Are we in a bubble, or are we at the peak? Are prices going to go down? What's going to happen when prices go down?
Yeah,
so we're gonna,
what happens when prices go down?
What happens when prices go down? Well, it's kind of funny. I do follow a lot of economic blogs, and someone just referred me to a couple of new ones that I hadn't heard of before. I'm not going to promote any names here on the show today anyway, but I have read recent blog posts by 3 different economists that about the real estate industry. 2 of them are California-based. One is more of a national base. And none of those, here's the other part, that was 2 of the 3 had both accurately predicted the demise, the crash of although I hate that term crash, because the market,
correction.
The real estate market corrected over a 3, almost 4-year period. There was no crash.
That's
it just when it started to go down after 2007, it just kept going down. It just went deeper and longer than anyone had ever saw before. And that's actually a really important point, that real estate markets don't crash, they just correct, and it's really about how much they correct and how long the correction lasts. And 2 of these 3 economists had both predicted the real estate market correction, and one whose first name is Ivy, she's a woman, got called the name Poison Ivy and was belittled for making the prediction that the real estate market was due for a major correction. And anyway, all 3 of these economists are not seeing anything on the horizons that would indicate that we're due for anything other than smaller year-over-year appreciation rates, flattening potentially in many markets, and in terms of a correction, we all know what happens to condos and townhouses. They tend to correct first and more than single-family homes, and because of all the building that's going on in San Francisco in particular, we might end up seeing some downward trending in the condo prices. But we're just we're in a situation in California where not only are we not for the past several years building homes to sustain the influx and the continuing increase in the population. And yes, California's population is increasing, notwithstanding anything you're hearing otherwise, that they're all moving to Texas. That's just nonsense. Or Portland or Seattle. We have a net immigration into California. We're not building enough new homes, and the existing home stock is getting older. So what that is doing is people are moving into homes and then remodeling. So the remodeling industry is on fire right now. So there's a lot of underlying support for the real estate industry and the real estate economy going forward. So I do not see it, and the people that I'm reading whose opinions that I respect are not calling for it. In fact, what's happening now is that people are they're hedging. They're saying, well, we don't see a recession or real estate recession or real estate correction in 2017, and we don't see it in 2018, but maybe 2019, because 2 to 3 years out, it's easy to say then, but the next 24 months certainly don't look like we're in for any surprises. Of course, unless something extremely major happens elsewhere in the world, or some event that's unexpected, notwithstanding. But generally speaking, the real estate market looks to continue to be strong. Certainly not accelerating at the same pace it did before. But real estate and real estate-based investments, which is what we're going to talk about today's show, look, at least in our opinion, to be strong going forward into 2017 and 2018.
Well, it's interesting. I was just thinking when you mentioned about the condo market, and I was thinking of San Francisco and specifically the Millennial Tower,
Yeah.
the leaning tower, so to speak.
Articles every week about that.
Yeah.
Not good.
And I'm wondering, okay, so if some of these townhouses or condos are plummeting, let's say, because of that, you have to kind of look at the mean, median, and mode, right?
That's right.
Because a condo that was $2 million that goes for $1 million can skew things if you don't look at it, in comparison.
You do. You have right, and that's actually correct. There's a significant enough opportunity there for a price drop that actually could statistically sway the San Francisco condo price statistics. You got to watch out for that. What's the story behind the story?
All right, so we're going to cut to our first commercial break. Before we do, want to make a little mention here for sailing the San Francisco Bay aboard a luxury tall ship with a professional captain and crew. All sails depart from lovely downtown Sausalito, and you do this on the San Francisco Bay. What does it have to offer? On the schooner Frida B. So check them out at www.schoonerfridab.com or call 415-331-0444. They got some very interesting sales going on, moonlight sales and all that kind of fun stuff.
Love moonlight sales.
Yeah, those are great. Okay, so here's our first trivia question about celebrities before they made it big. Before this man made it big, he had a small part as Chip Diller in the 1978 movie Animal House, then as Jack in the 1980 movie Friday the 13th. He showed why smoking in bed is very bad for his throat. In Apollo 13 in 1995, he and two friends had a problem. Who is this guy? All right, don't touch that dial. The best of investing will be right back. You got to call 888-912-1190 to answer that question. First person with the correct answer is going to win the free tanning certificate. Yeah, right. Yeah, went a little over. That's okay. They can just take out someone else's commercial.
740. Yeah, I guess we got a few more. Did they adjust it a little bit, or just give us another minute?
No, what happened was like something I had from before fell off.
Okay, got it. Yeah, so 740. Okay. I'll turn my thing on next time, so I get 910.
I was on the phone with AT&T for over 3 hours.
Oh, I hate that. That or Comcast. It's just ridiculous.
It's amazing. But at least they did give me someone in the United States. Still, it's the first question you have to ask.
But you can end up with someone from the United States that's in some basement in Atlanta, and their accent's so thick.
Yeah,
They're not really highly educated.
Yeah.
It's just,
Don't
oh my God, they're reading from a script.
Yeah, I had to go to the loyalty department, as they call it.
Mm.
Yeah, it was kind of tough.
I'm going to turn my clock on this time.
Okay. You ready?
Yep.
All right. Away we go. Well, welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt of Pacific Private Money. Our first trivia question was celebrities before they made it big. Before this man made it big, he had a small part as Chip Diller in the 1978 movie Animal House, then as Jack in the 1980 movie Friday the 13th, where he showed why smoking in bed is very bad for your throat. And in Apollo 13, he and two friends had a problem. Who was this guy?
The only one I can think about is Tom Hanks.
No, Kevin Bacon.
Oh, right.
Yeah, remember that?
That's right.
It's a very small part in the 1978 Animal House. Okay, so Mark, it's just mano y mano here.
Yeah, we were talking about in the first segment the state of the real estate industry as I study it and as I read and listen to experts in the industry who really don't believe that we're due for a major correction, and we're certainly not in a bubble because prices are appreciating largely due to affordability, meaning cheap money, not necessarily affordability in pricing, but the low interest rates in mortgages, and the fact that they're just not building enough homes. So there's demand. Demand is pushing up pricing. So it's the whole supply and demand curve. But what I want to talk a little about more in this segment is how companies like ours, Pacific Private Money, and which are alternative real estate funding sources. Back in the day, 15, 20 years ago, we were all referred to as hard money lenders. Last 10 years, companies that are new, like Pacific Private Money since 2008, many of us refer to ourselves as private money lenders, kind of the softer, easier naming. And we're really not like those hard money lenders of yore. It's funny, I still run into real estate professionals every day who say, oh yeah, I know what you guys do, hard money, you guys make seconds to people who are in financial distress. And my response to that is, no, that's not correct at all. We do make seconds, but that's only a small percentage of our overall volume. Most of the loans we make are purchase money loans, purchase money first position loans, and we don't make loans to buyers in distress. We usually make them to, because the deal, either the property is in distress or the deal, the transaction itself is in distress. Distress meaning it was supposed to close last week, but the bank financing hasn't come through yet. And that is a growing dilemma for many people who are buying real estate today. The other dilemma for people buying real estate today is if you need to use bank financing, you might find that you're trying to buy in a market space where cash buyers continue to get the deals because they can close more quickly. In fact, I've got real estate for sale right now in Oakland myself because I like to buy fix and flip real estate with some of my clients, alongside with some of my clients. I'm an equity partner with several flippers, and we love it when a cash buyer comes in, 21-day close, boom. Those are always my preferred versus a 30 to 45 day escrow with a
loan contingency.
Right, with loan contingency, because again, I might feel for the applicant, hey, first time home buyer, but look, this is a business, and I got to move this property. So, so companies like Pacific Private Money are in business today to provide funding for those real estate transactions where bank financing either can't operate quickly enough, thanks to 30 to 45 day average closing times today with bank financing, or they're trying to compete with cash buyers, or they're buying property that simply isn't bank financeable. And I will tell you right now that most people buying, fixing, and flipping property already know this. Most banks and conventional lenders don't want to make loans to flippers.
Yeah.
They don't like to make short-term loans. Many flippers, due to the nature of their income, don't qualify. Many of them have credit that's just, they don't have high credit scores, largely because of just the nature of the people who oftentimes are in the business of real estate flipping. They've got a history, and maybe they didn't fare well in the last turn down, so they may have a foreclosure or a short sale that has skewed their scores. So there's a lot of reasons why people come to companies like Pacific Private Money to borrow money. So nobody comes to get a loan from us because of our rates and our fee structure when they can get bank financing. So it's really, we're a plan B when plan A fails.
Except, I'll throw an exception in there. There are some borrowers who get so frustrated with banks.
Your
paperwork.
That's actually true.
Yeah.
That's not an untrue statement.
Yeah. It's just every once in a while, it's just like, you know what? It's going to cost me a couple of points more. It's going to cost me a few interest rate, a few percentage points, percentages in interest.
Yeah.
But the hassle factor is, even though they might have all the time in the world to get a loan, it's just so much easier.
That's actually true. We do have some repeat clients that say, look, yeah, I could go to the bank, but you guys are just so much easier to deal with. And, we're double the price of bank financing. But a lot of our clients who use us don't intend to have the loan for long.
Yeah, they might want to sell it.
Right, so they bake in the cost of the financing into the real estate strategy. So so unlike hard money lenders of 20 years ago who were making a lot of seconds, or when they were making first position loans, they were largely development or distressed borrower situations. Unlike that, today many of my borrowers have high credit scores. So I just had a meeting with a potential investor in our company this week, and he peppered me with many questions, including one about credit scores. Tell me about the credit scores of the people you loan to, because his assumption was we make loans to people with bad credit. And so I showed him some files where we had, of course I had to hide the names because this is privacy issues, but we have done more loans to people with credit scores over 800 in 2016 because they were in a transaction that all of a sudden was getting held up. In fact, most recently, I shared this as a deal last week, we did a transaction for a family that was paying, and this was a wealthy family with good income, although it was self-employment income, which was one of the factors why their bank financing was getting stalled. But they had high credit scores in the 800, and they were buying a $4.4 million property with $1.4 million down, and they were getting a $3 million loan. Well, they had already gone through 2 extensions from the seller. The seller refused to grant a 3rd extension, and their deposit money, the $130,000 they put down as a non-refundable deposit, the seller was going to keep it. He said, if you can't close by Friday, I'm selling it to the backup buyer that was still interested in the property, and I'm going to keep your deposit. And so they were frantic. They not only didn't want to lose $130,000, they wanted the property. So we were able, in 7 business days, we were able to close a $3 million loan for that person. And that's just one example of dozens and dozens of loans that we've done at Pacific Private Money this year. Where either a realtor or a mortgage broker called us with a client that was in a situation of some form of transactional distress, not credit distress.
No, your deal of the week example's perfect. That was 68% loan to value.
Yeah, it was absolutely amazing. So that's the type of transactions, really, really strong transactions. And so when we come back, I'm going to kind of transition from the types of loans we're making to the types of yields that our mortgage pool fund at Pacific Private Money is providing as it is making these types of loans to very strong buyers on beautiful properties here in the Bay Area.
Yeah, because you're not going to want to miss this, because Mark's going to talk about how his fund is earning very, very close to 8%. All right, quick mention here for the seahorseranch.org. Have you ever been horseback riding in Half Moon Bay on the beach?
On a seahorse?
On a seahorse, yeah. Well, actually, that's the name of the ranch.
Okay.
I got to go see our friend Willa at in Half Moon Bay. Did this once before, and it's a fantastic ride. You actually ride the horses on the beach. Seahorseranch.org. Call 650-726-9903. All right, second trivia question. Celebrities before they made it big. Before she made it big, this woman played a small role as a hitchhiker robber in the 1977 movie One-on-One with Robbie Benson, which I've seen, and it's hard to find that movie. Later, she gave up her wild ways and figured out that life as a, quote, working girl would be more promising. Who is this woman? Call 888-912-1190.
Working girl. Her name's at the tip of my tongue. Dang it.
You will know the name. Did you get a copy of the Rob Black interview?
Oh, no, I have not.
Oh.
Did you get it by email?
Yeah.
Maybe forward that to me.
Sure. And then, but it's not airing yet. But he said it will air. He'll let us know when.
Okay.
But he thinks they may edit it a bit, just because he went on a little long. He only went on 7 minutes.
Okay.
Maybe that's not very long.
Whatever.
Oh, here it is. Forward this to. Waiting.
All right.
earn mucho dinero. There we go. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money. Before she made it big, this woman played a small role as a hitchhiker robber in the 1977 movie One-on-One with Robbie Benson. Later, she gave up her wild ways and figured out that life as a, quote, working girl would be more promising. Who is this woman?
Drawing a blank.
Melanie Griffith.
Oh, Melanie.
Melanie Griffith. Okay, so Mark, we teased the audience about how they can earn mucho dinero in your fund. Explain more about that.
So, private lending brokerages like Pacific Private Money are in the business to serve that growing segment of the marketplace that can't get bank financing. Either it's fallen through or the speed of the transaction precludes them from using conventional means, and they come to a company like Pacific Private Money for our fast, reliable, hey, and friendly. We may charge a lot, but at least we make it a painless process. In our loans, we didn't get a chance to talk about the price of one of our privately funded loans. But they average between 9 and 10%, depending on the loan to value and the kind of the metrics of the deal, the borrower, how strong they are, how long do they need the money, where's the property at. So we're very holistic in the way we look at these loan applications. We're basically looking at the borrower variables and the property variables and the transaction variables, and we kind of make an assessment. But generally speaking, our average loan rates are between 9 and 10%. And again, people don't usually hold our loans very long. We're in the short-term lending business. Very few of our loans go longer than 12 months. And then there's, fees. There's a couple of points because that's generally how brokers make their money is on the origination fees and the junk fees. And the lenders, the members of our fund or the individuals who fund our loans, they're the ones who are the beneficiaries of the lion's share of that 9 or 10% note rate. And so let's talk a little bit about those people who provide the capital that we use to make the loans at Pacific Private Money. So we do we allow two types of mortgage investing at Pacific Private Money. We do work with certain high net worth individuals who are experienced at investing in real estate secured notes. Sometimes it's called trust deed investing. That's a very common California term for investing in real estate secured notes, trust deed investing. If you're an experienced trust deed investor and you're looking for some additional investing opportunities, feel free to give us a jingle at Pacific Private Money. We're always adding to our list, but you got to be experienced. We're not working with inexperienced note investors. The reason for that is just that the speed at which we have to get these deals underwritten, get funding commitments, draw up the loan docs, and close. I mean, speed is one of the reasons why we exist. That need for speed is a service we provide. The second way, and the growing in popularity way to participate in mortgage investing and get yields between 7 and 8.5% on average in California, is to invest in a mortgage pool fund. And so at Pacific Private Money for the last 3.5 years, we have had the Pacific Private Money Fund. All it does is invest in local mortgages that we originate at Pacific Private Money. And last year, 2015, we had a distributed yield to our shareholders of 8.2%. Now in 2016, that rate has trended down a little bit. We're at about 7.9% on a distributed annualized yield, and that's really because there's been a little bit more competition. Rates have gone down a little bit, but also we've just decided internally that we've seen such high quality deal flow come to us at Pacific Private Money, thanks to our marketing efforts with mortgage brokers and realtors. We've lowered our rates a tad, to accommodate higher net worth, higher credit score investors who, quite frankly, were sticker shocked when we started quoting them 9.9%. It's like, oh my goodness. It's a shock from 3.5%, 4% mortgage rates. But again, we're that's not our money. It's our client money. It's our investor money, and that's the average yield paid out in California. So you kind of have to serve the marketplace. So So at Pacific Private Money, the fund is paying, and again, that's the distributed yield. That's net of all fees. So I had a lengthy conversation this week with a potential investor in our fund, and that person must have asked me 4 different ways. So, is that before or after marketing fees? Is that before or after the manager fees?
Yeah.
Is that before or after XYZ fees? And I
Is
had
it
to
really, really net?
it's the net to you. It's we've got, there's the income to the fund, which is the note rate plus a portion of the origination fees get thrown in, and then the way the money is distributed is we first pay the expenses, then we pay the manager fee. We don't pay any overhead or marketing fees. That's borne by the brokerage company, not the fund. So then the preferred return of 7% gets paid out to the fund members, and then whatever's left over, and there's always something left over, or always has been something left over so far in the life of the fund, that gets split 50-50 between the management company and the manager and the shareholders. And so, thus far in the 40 months that we have been, that the fund's been in existence, not Pacific Private Money, we've been in business for 8 years now. But the fund's been in business for a little over 3 years, and we have been paying out monthly at a rate that approximates, now just under 8%. During the life of the fund, it's been a little bit over 8%.
That's on a monthly distribution, though, but you have the ability in the fund to reinvest.
That's there's a number of benefits to investing in a fund versus investing in an individual note. And some of those benefits are as follows. One is, as Edward pointed out, if you want to invest money from your IRA and you're not taking distributions yet, you can allow the dividends that we pay to compound. You can buy more shares each month, and so the compounded yield in 2015 was close to 8.6. So there's those 12 compounding periods actually do boost your rate up anywhere from a quarter to a third of a percentage point. Just the difference between the distributed and compounded yield is more than you can make in a money market account right now and from many banks. One of the other benefits is you can invest whenever you want. You can add to your investment. You don't have to worry about early payoffs. That's another thing that's in today's world of privately funded loans. A lot of our loans pay off between 4, 6, or maybe 8 months, but 4 to 6 months is not unusual. So you go through all the trouble to invest in a note, then you get your money back, and it's sitting back in cash again.
Okay, so for the audience, let's say, who wants to call you now and leave a message because you're not there at the office at this very moment.
It's Saturday, right?
Yeah, but give out your information, and then when we come back, we'll talk more about it.
Well, go to pacificprivatemoney.com. That, of course, is our website, pacificprivatemoney.com. That's where our contact information is. You can send us an email. Phone number's on there, too. Our bios of the company team members, everything's there. We try to be very transparent at Pacific Private Money. Phone number 415-883-2150. Again, 415-883-2150. If you want to dial it up right now and leave a message, we'll get back with you and send you a package on how you can earn as much as 8%, sometimes more, on your savings or retirement accounts through the Pacific Private Money Fund.
And when we come back, we'll talk about the risks and foreclosure potentials.
Absolutely.
And that sort of thing. Okay, so you're not going to want to miss that. All right, quick mention here for the Cityscape Viewing Lounge at the Hilton San Francisco Union Square. 360-degree views that are out of this world. You got to check them out. It's at the Cityscape Viewing Lounge at the Hilton San Francisco Union Square. I've been there. Food is excellent and views are unsurpassed. Okay, last trivia question here for the day is, before this guy made it big, he played a high school football player named Charles Jefferson in the 1982 movie Fast Times at Ridgemont High. That's a fun one. He's done many movies since then, and he's won an Oscar in 2007 for Best Actor. Who is this guy? Again, call 888-912-1190.
That's Spicoli. Totally. Some days I can't remember names to save my life.
Well, long days and stuff.
Yeah. I think I'm going to be batting 0. strikes you out.
Well, again, you'll know the guy.
Yeah.
I mean, you remember the movie, right?
Oh yeah, Fast Times at Ridgemont.
Yeah.
High, absolutely.
Love that movie.
Love that. So this next one is 919.
Yeah.
Okay.
Okay. I can ask you the email that we received for review is about if the loans you make are usually below 70%, would foreclosing actually be a good thing for your investors? All right. Trivia question. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with Mark Hunt. Before this guy made it big, he played a high school football player named Charles Jefferson in the 1982 movie Fast Times at Ridgemont High, and he's done many movies since then and won an Oscar in 2007 for Best Actor, which was The Last King of Scotland, if you remember. Who was this actor?
Well, I love that movie, but
Yeah.
I don't remember who this actor was.
Forrest Whitaker.
Forrest Whitaker, of course.
Okay, so Mark, we got an email
Mhm.
for you, and it kind of leads into what I teased the audience with about let's talk about the risks in foreclosure.
Sure.
So this email comes in and says, if the loans you make are usually below 70%, that's about what you've been saying on the air,
Mhm.
wouldn't foreclosing actually be a good thing for your investors?
Well, technically, yes, foreclosure would be a good thing, assuming that we did our homework correctly and that we stuck by our general underwriting guidelines, which is that we tend to make loans no higher than either 70% of the purchase price or 70% of the current market value, because sometimes people bring us deals that are off market and below market priced. So if we do that and we make a loan and the borrower doesn't pay, absolutely, if we foreclose, we could sell that property potentially for a profit. Now that assumes that when it goes to auction, somebody else doesn't buy it and just pay off our loan, which would be pay off the loan, pay off all accrued interest, pay off the default rate at the default rate of interest, assuming that we're allowed to have one on that type of loan, because some loans you can't charge a default rate of interest.
Yeah, like
all
personal residences.
right, exactly.
Yeah.
That's now.
And by the way, what are those? What would the default interest rate be on a business loan?
Well, on a typical fix and flip loan or business purpose or investment purpose loan, our current loan documents provide for a 5% default rate of interest differential. So if the loan rate's 10% and it goes into default, the default rate that it begins to accrue at from the point of default would be 15%.
Holy smokes.
Plus the 10% late charge that we charge. Again, on investment loans, it's 4% on a consumer loan. And again, all those little nuances. But getting back to the question of foreclosure, would it be good? It potentially would be good, but I will tell you that our default experience at Pacific Private Money is ridiculously low. It's actually less than the industry average for mortgage default. So we've done.
Well, I'm going to guess why.
We've done
because your loan to values are fairly low. Nobody wants to lose their property.
Well, although so we were making loans in 2008, 2009, 2010, and the market was still correcting. It was still going down, and yet most of the loans we made were paid back successfully, and the flippers for the most part were making money. But we actually did have several foreclosures early on in the history of Pacific Private Money. But our investors in those loans who actually foreclosed on those borrowers, they all made money. They were all better off. In fact, some of them still are holding the properties today because they were good income properties. But we have had less than 10 foreclosures out of 1,200 loans that we've done total at Pacific Private Money that we've originated in-house with private capital. And then in the fund, we've done about 150 loans in the life of the Pacific Private Money Fund, of which we have still 70 loans are in the portfolio today. We foreclosed on 2 loans. Both of them were flippers who got in trouble. One had flipped too many properties at the same time and couldn't keep up with the payments, and we ended up foreclosing on that property. The other one was a similar story. We're making a really nice profit on one. The other one we're marketing right now, but one we took back and did a major remodel. The costs were advanced by the brokerage, not the fund, and So that one is soon to be in contract. We're entertaining multiple offers on that right now. That would be a nice profit to the fund. So, but here's the thing: we don't like to foreclose. So we're really, again, we have two clients that we serve. We serve our investor clients and our borrower clients. Now, truth be told, I weigh more heavily in favor of our investor clients. I feel my fiduciary responsibility is first to those providing the capital, but second, I do feel an obligation to our borrower clients to help them get out of a jam when they're in a jam. So we don't just automatically, after two missed payments, file a notice of default. We're in communication with them. We're in communication. If it's an individual investor in that note, we're in communication with that investor to see if he wants to entertain this, whatever the story is behind the borrower. So, we tend to, we have a reputation for working with our borrower partners and to make sure that we give them every opportunity to correct whatever problem they've come up with and help them work out a solution. So we're not in the foreclosure business. We're not a loan-to-own company. There are companies in the Bay Area that are. There are companies in the Bay Area that will make anybody a loan under just about any circumstance, a real estate secured loan. And those same companies have 30, 40, 50 foreclosures going on at any given time in the Bay Area. They're just, hey, we'll make you the loan. You tell us you need the money. We'll pay for it properly. And but if you miss a payment, boom, we're filing foreclosure and you're out of luck. And it's really unfortunate. I don't subscribe to that business model. That's not it's not the model we're in. But so while we're kind of talking about risks, so one of the conversations I always have with potential investors is, so what are the risks of investing in the Pacific Private Money Fund? Okay, well, Mark, your fund has only been in existence for 3.5 years, and your company's been in existence for 8 years, since 2008, but you really haven't gone through a real estate cycle. What's going to happen when the next real estate cycle hits and real estate prices go down? How is that going to impact the fund specifically? And the answer to that is, great question. So we make short-term loans at Pacific Private Money. Now, in the 70 loan portfolio of the fund right now, we do have some 24 and 36 month loans, but that is not the norm. There's probably 4 or 5 very well secured properties that we've granted a longer term, because that particular borrower was not going to be able to get bank financing due to the nature of their credit, but the collateral was strong, cash flow. These are all investment properties. We're generally not making long-term loans on residential properties on a primary residence, because again, we're not really in the business of making 10% loans to someone's primary residence. We'll make them when they're going to get conventional financing to take us out. So because the average payoff in loans that we make out of our fund is less than a year, how much is real estate going to decline on average in a real estate cycle in a 12-month period?
15%?
I don't even know that it's ever gone down that much in a 12-month period. I mean, that's 5 to 10% would be a lot. Correct. So if we're lending at 70%, and oftentimes we're lending at less, because the weighted average loan to value in our portfolio right now is 55%. We've got a combination of loans with LTVs as low as 25, 30%, and then we've got as high as 70%. But if the market corrects 10% or 15% within a 12-month period, and we've got loans that are outstanding that need to be paid back, we're still well protected. The borrower might be disappointed because maybe they're not going to make as much money if their exit strategy was to sell maybe an investment to sell. But if it's a borrower we helped buy that property and they bought it at the top of the market, now they're going to conventionally refinance, well, they can still get an 80% or even higher refinance loan and pay us off.
Or sell the property.
Or sell the property if they had to. So again, a correction in the real estate market is not necessarily going to be the risk that one would need to worry about. And when we get back, as we're kind of wrapping up the show, we can talk a little bit more about some of the other risks that people often will ask about. But by and large, when you get a chance to look closely at the Pacific Private Money Fund and get a chance to meet with us and talk with us at length, we'd like to share with you all the safety and security features that we've built into the fund to ensure that capital preservation is our number one goal.
Don't lose my money. That's the important thing.
Absolutely.
Okay. All right, we're going to cut to our last commercial break, and just want to make a quick mention. Paintball, excellent choice for Christmas present. Check on our website, bestofinvesting.com. Click on the paintball icon. You'll see exactly what we mean. And don't forget those Tan Bella certificates. You can always check out tanbella.com. See all the services they have. Don't touch that dial. The Best of Investing. I'll be right back with some closing comments. Okay. I'm sure I'm going to hear from Keith with Russ about, you guys went over. And I'll go, tough titties.
How much over have we gone? Each segment have we gone?
Yeah, but I think it'll be okay. And I can probably monkey around with the clock a little bit in there too.
We can go a little bit. I don't know if it's got the
No,
hard
just
breaks
keep
though,
it.
right?
Yeah, but I mean, this one's only going to be 5 minutes, so
Yeah.
just keep going. We just keep going. See, I don't mind when they put like, hi, this is Mo Ansari. Listen for us, and they have that on our show
Yeah.
because they're giving us extra Pacific Private Money commercials on their shows, so that's okay.
Yep.
And their times are actually, could be drive time, right?
Yeah.
So
Absolutely.
that's actually not bad.
Drive time is great time.
Yeah.
Strategic coach. That's my.
Oh yeah, you know what? I forgot to tell you this. Went to church last week. Met a guy who is a mortgage broker.
Mm.
He said, "Oh really?" He goes, "Yeah, I work for People's Equity." And I go, "Man," I go,
Jeremy.
"Is that Jeremy Forcier's company, right?" He goes, "Oh yeah, he's my boss." So we had a really nice, nice
Awesome.
conversation. And he says, "I might have a deal for you." I said, "Excellent." All right. Welcome back to the Best of Investing. Last time for today. I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money. Mark, tell us more about the risks.
So we've been talking about real estate. We've been talking about companies like Pacific Private Money that are private money lenders, hard money lenders, whatever you want to call us, alternative sources for real estate financing. We've talked a little about our mortgage pool fund, the Pacific Private Money Fund. One thing I forgot to mention at the beginning is that past performance is not a promise of future results. So even though we've been paying pretty religiously, right around 8%, that's not a promise that it will always happen that way. But we believe, based on where we see the strength of the real estate market, the types of loan demand we have, and the continuing demand that we foresee thanks to new regulations like Dodd-Frank, we are fairly confident that we are going to continue to provide extremely strong yields above 7% and at or near 8%. With safety and security features that you're just not going to find in other investment opportunities. And look, we all like to invest in the stock market. The stock market historically has done very well, although it does cycle like everything else. But I got to tell you, I'm nervous about the stock market, as are a lot of my investors who are increasing their accounts with Pacific Private Money, because they're reading articles and hearing stories about predictions that over the next 5 to 10 years, the expected returns on the stock market, particularly indexed funds, is likely to underperform our prior expectations. In fact, we shared an article last week where it said that the likelihood of making 5% annualized return over the next 10 years in the stock market is looking pretty slim. Now, again, that's the opinion of Bloomberg and one of their writers, not necessarily everyone's opinion. But let's talk about some of the other risks that sometimes people ask me about. Well, they ask me about things like, well, what if I need my money back? It's not a liquid investment. Well, we've designed the fund to be a source of short-term financing options for people, and so since we're always getting payoffs on a fairly regular basis, and we're continually in fundraising mode. We're at $21 million right now in the fund. We're looking to grow it to 50. And at any given time, we typically have close to $1 million cash in the fund. So we are redeeming people who've been in the fund for several years and oftentimes need to make a partial redemption. That's not been a problem for us. Now, of course, should there be some horrific economic or world event, and there's a so-called run on the bank. Well, of course, we are an illiquid asset. We can't automatically convert those loans into cash. So, that is one of the risks that you have to factor in. But again, generally speaking, you're not going to find 7 to 8% yield opportunities in a liquid investment.
No, but here's the other thing, though. Your documents say that when a loan gets paid off, before you make a new loan,
Yep.
you have to first see if anybody wants to
You
get
have
out.
to honor redemption
Yeah.
requests. That's true.
So that actually can produce a lot of liquidity because you're constantly getting paid off on loans.
Right. What kind of oversight do you have in the fund is a lot of questions we ask. Well, we have a third-party fund manager. This is a company that manages 40 other funds in addition to the Pacific Private Money Fund. And money cannot go in or out of the fund operating accounts, which are held at Wells Fargo Bank, within 24 hours. We need to tell them what that money was for. What was the money that was deposited, or what was the money that was taken out? And the fund is annually audited by a CPA firm that specializes in fund audits. So, and those audits are available for your review, and the monthly financial statements are available for your review. So, again, we're very transparent in the loans that we make, the people we make the loans to, where the properties are located. You can get a list of loans that includes all of that information at any time if you're a member of the fund. So, again, transparency is something we place a high value on, and again, you can come visit our office and come look at the files that we're underwriting and talk to us about the loans we make. We've got a great team at Pacific Private Money. Our two underwriters have a combined experience of over 60 years of conventional loan underwriting, and now they work for us doing alternative financing. So for more information, go to pacificprivatemoney.com. We're about to launch our brand new updated website. You'll see that soon. Or call us, 415-883-2150.
All right, we got to cut out for today. Here's our thoughts for the day. Now, on my day, we didn't have handheld calculators. We had to do addition on our fingers. And to subtract, we had to have some fingers amputated.
Trusty abacus.
That's it. Excuse my naivete. I was born at an early age. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Okay. Excellent. Mr. Smithers. Excellent.
Yes.
It's like a mortgage investing 101.
Yeah.